In this, the 22nd lesson in the course, A Critical History of Economic Theory and Policy, we explore responses to societal challenges by social scientists, political scientists, and others. The human experience is really a long history of struggles. Struggles against harsh natural environments and disasters, against domination and oppression by powerful external groups or internal elites, against systems of law created to institutionalize privilege for some at the expense of others. In the 1950s and 1960s, the struggle for civil rights was also a struggle for access to public goods and services, to employment opportunities, to education, to health care, and to housing. Historian Gabriel Kolko explained in 1962 that despite the appearance of great prosperity, little had changed with regard to the concentration of wealth and income in the United States. Kolko wrote, despite the obvious increase in prosperity since the abysmal years of the Great Depression, the basic distribution of income and wealth is essentially the same now as it was in 1939 or even 1910. Most low-income groups live substantially better today, but even though their real wages have mounted, their percentage of the national income has not changed. Similar concerns brought philosopher Mortimer J. Adler together with lawyer Louis Kelso to collaborate on what they believed was a revolutionary plan for a capitalistic distribution of wealth as a means of preventing the United States and other social democracies from being subverted by the tendencies of state socialism. Their book, The Capitalist Manifesto, which appeared in 1958, offered a vision of a truly classless society based on the universal ownership of capital goods. They wrote, accordingly, the concentration of ownership in the hands of some men or families must not be allowed to go beyond the point where, under a just system of distribution, it would prevent other men or families from earning a viable income by participating effectively in production. When the preponderant portion of the wealth is produced by capital, participation in the production of wealth must be preponderantly through the ownership of capital, a requirement which at some point imposes a limit upon concentration in the ownership of capital. The practical program to achieve this outcome of universal capitalism took the form of the Employee Stock Ownership Plan, first introduced by Kelso in 1956 to enable the employees of a closely held newspaper chain to buy out its retiring owners. ESOPs have a somewhat checkered history, however, because of the prospect that a company's stock might lose most or even all of its value in the future, leaving employees with nothing saved toward retirement. Downplaying or even ignoring the ongoing problems of generational poverty and the concentration of wealth and income, many mainstream economists, historians, and others were applauding the progress of an invigorated and demand-managed American system. In 1968, Harvard University professor Paul Samuelson asserted, the new economics really does work. Wall Street knows it. Main Street, which has been enjoying 92 months of advancing sales, knows it. Actually, the economy of the United States and the global economy generally were already showing signs of instability. Then, a U.S. economy increasingly dependent upon external supplies of fossil fuels was brought to its knees by OPEC's orchestration of an historic shift in purchasing power from the world's industrial powers to the world's possessors of oil. Another part of the economic equation was that successive United States Congresses and presidents committed the nation to outspending the Soviets and Chinese, ostensibly in defense of the free peoples of the world. Between 1946 and 1967, the U.S. government spent $904 billion on the military establishment. By 1965, nearly 6 million people were employed in or by the military and defense industries. During the Cold War, the average military budget each year was $342.4 billion. Truman and Eisenhower triggered an intensified level of military invention by deciding to support the French attempt to regain control over their pre-war colonial holdings in Southeast Asia. By 1954, the U.S. was paying 80% of the financial cost of the war against the Viet Minh. By the time of the U.S. withdrawal in 1975, over $140 billion had been spent. An estimated 2 million non-combatant Vietnamese people were killed during the war. Some 1.1 million North Vietnamese and Viet Cong fighters were killed. The South Vietnamese military lost between 200,000 and 250,000 soldiers. The United States experienced 55,220 fatal casualties during the war. What might have been is difficult to say, but John F. Kennedy indicated he was more aware than many others of the U.S. position in the world. He stated, "We must face the fact that the United States is neither omnipotent or omniscient, that we are only 6% of the world's population, that we cannot impose our will upon the other 94% of mankind, that we cannot right every wrong or reverse every adversity, and that therefore there cannot be an American solution to every world problem." The question asked by progressives was whether Kennedy could ever understand the nature of the problem of poverty and champion the needed changes in law and public policy. Whatever his real promise as a change agent, his assassination assured we would never really know what he was capable of. In July of 1965, Lyndon Johnson made his fateful decision to escalate U.S. military involvement in Vietnam. Then, in January of 1966, he went before the U.S. Congress to argue the case for both guns and butter. Johnson said, "I believe that we can continue the Great Society while we fight in Vietnam." How to achieve what no other nation had ever achieved in history was the challenge he put before his team of economic advisors. One of the most influential Keynesian economists in the early 1960s was Walter Heller. John F. Kennedy brought him from the University of Minnesota to become chairman of the Council of Economic Advisors, and he remained when Lyndon Johnson became president. During the Kennedy years, Heller advocated cuts in the marginal federal income tax rates. The tax cuts were passed after Lyndon Johnson took office, but Heller's efforts to have loopholes and tax privileges closed were ignored. Thus began the process of income concentration upward. As early as 1964, fearing that inflation would rise with a surge in federal spending to pay for the war in Vietnam, Heller reversed his position on taxes. He appealed to President Johnson for a tax increase, but the president rebuffed him. This led Heller to conclude, "The dream of a thorough tax reform is just that, a dream." Economists, and many economists and non-economists holding a more defined ideological perspective, debated and debated the design of a system of public revenue that would raise an amount sufficient to pay for needed and desired public goods and services without negatively impacting economic growth. As Heller learned, even when economists seemed to be in general agreement, the politics of taxation intervened, and powerful vested interests often secured protections. Governments were left with one of three remaining strategies: reduce spending based on actual revenue, compete for funds in the credit markets, or urge the central bank to create new money out of thin air and use this to purchase government bonds. Reduced tax rates and investment credits greatly increased business profits. Corporate profits doubled between 1961 and 1966, but did not result in a significant increase in the creation of new capital goods. Note that this was accomplished during the period of labor union strength. The tax cuts overwhelmingly benefited those with higher incomes. Opponents argued that the supply-side gamble did not pay off in terms of revenue to the federal government, that $25 billion more would have been collected by 1966 without the changes in tax rates and without harm to overall economic growth. However, proponents of even lower rates of taxation have interpreted the statistics differently. Daniel Mitchell of the Heritage Foundation concludes, history demonstrates that lower tax rates are good for the economy. The tax rate reductions in the 1920s, 1960s, and 1980s all resulted in faster growth, rising incomes, and more job creation. Moreover, even though critics complained that these tax rate reductions would allow the rich to keep too much of their money, upper income taxpayers actually wound up paying a greater share of the tax burden during all 3 decades, because lower rates reduced the incentive to hide, shelter, and underreport income. This chart shows that regardless of changes in tax rates, government rarely operates with a balanced budget or with the kind of surplus Keynes argued for to build up a fund available to spend during economic downturns. What Mr. Mitchell ignores is the fact that when tax rates on high marginal ranges of income are lowered, a good deal of this added disposable income is invested in ways that do not necessarily result in greater job creation or new capital goods production. Asset managers challenge the funds into the stock market, into real estate, into precious metals, or into collectibles, all markets that are speculation driven. The cuts in tax rates during the 1960s occurred at a time when consumer purchasing power was not nearly as concentrated at the top as is now the case in the United States. In essence, the demand side segments of the economy's most speculation-driven markets are capitalized into higher and higher prices that eventually pull the overall economy into the bust portion of the so-called business cycle. Between 1960 and 1965, the U.S. economy kept up reasonably sustained level of growth, as measured by increases in gross domestic product. Then, despite enormous increases in government spending, GDP growth tapered off and fell to zero in mid-1969. What was happening? Analysts outside of government noted, however, that the increases occurred to a significant extent because of huge increases in government spending on direct and indirect expenditures on the military while trying to wage a parallel war on poverty. Prices were pretty stable until mid-1965. after which Keynesian economists pointed to expenditures on the war in Vietnam as the primary cause of rising prices. Other economists pointed out that with near full employment, strong demand was pulling up prices. As in the past, almost nothing was said about the rising cost of land for housing, for business, or even for public infrastructure when land was acquired from private owners. These rising costs were passed on to retail and office building tenants, to tenants in apartment buildings, and anyone who leased land, with or without buildings. To the extent possible, these increased costs were passed on to customers and employers. We've reached the end of lesson 22.